You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
All right, everybody. That music means it's time once again for Options Playbook Radio, the program here on the old network where we break down the sometimes scary, sometimes just amazing world of options into offensive and defensive plays that you can use in your own portfolio. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the aforementioned network. And you're saying to yourself, what is that guy doing here? You're right. It's not my show. It's this guy's show over here. Let me toss you to your usual weekly host, the options guy over there, and the senior option strategist over there at Ally Invest, Mr. Brian Overby. Brian, welcome back to your own show, sir.
Well, it's great to be back, Mark, and I always love whenever we get the chance to get together because the listener questions pile up week in and week out, and we can always huddle up and answer a few.
It's time to huddle up and answer questions about your favorite options plays. Submit your questions via questions@theoptionsinsider.com, twitter.com/options, facebook.com/theoptionsinsider, or via the Trader Network at tradeking.com.
All right, everybody. Welcome to the Huddle. Like Brian said, this is a portion of the show where you guys take over and you dictate what the heck we're going to talk about. Brian, we got about 8 million questions, so I hope we set aside about 5 hours. That should do it. You got 5 hours for us?
Well, not quite, but we can try. We can get at least 5 questions.
All right, we'll see. Well, that's a good goal. 5 questions. I think we can see. We'll see. Some of these are pretty epic, so maybe not. But we'll see how many we can get going. Let's just dive right in. Let's start with BuseKrus D. That's an interesting handle. BuseKrus D says he's new to options and working with a small account size. Well, no shame there, BuseKrus. A lot of people in your same boat. Welcome to the options fold. He goes on to write, looked to put on a trade with a strategy from the Playbook, the Christmas tree butterfly, I think. So I think he's a fan of yours, Brian. With a 57, 60, 66, 2x3x1 call fly for a total debit of $1.30. They can tell this guy's a Playbook reader because he's all over the place on the strikes and the ratios, which is, you know, the old skip strike thing. That's your favorite trade, Brent. He goes on to write, I've always heard that for a defined risk debit trade, the max risk is the amount paid. However, the brokerage was saying I need around $740 in my account to be able to put on the trade. Is there an explanation? Is the capital required to put on a trade greater than the possible max loss on a defined risk debit spread? Thanks. He doesn't give us the... I appreciate the question. Sometimes it's helpful, or often it's helpful, when you guys write in with maybe the underlying, maybe months and things like that, so we can maybe look and see exactly what it is you're talking about and why your broker may be tempted to do this here. But not all spreads by all means are the same, and just because you paid a debit for it, there could be all sorts of funky short legs here. In this case, Brian, he's got what? 57, 60, 66 Christmas tree fly, 2x3x1. His broker is saying he needs to hold extra money. That's why I like having you on, because you work with a broker. What are some scenarios where someone would be coming in, maybe doing a fly like this, where Ally would maybe want to keep some extra dollars in the account?
Well, okay, so the key to this butterfly, and overall from just looking at it, not knowing the underlying, I understand, I would guess that the max debit paid is the maximum risk of the trade. And one of the biggest keys to a Christmas tree butterfly is that the options that you bought add up to the options that you sold. So you're buying 2 of the first strike and one of the last strike. So that's 3, and you've sold 3 in the middle. So that's a good start. And then the next key are the one that you're doing the ratio on, where you're buying more, that's 3 points wide, and the one where you're buying less on the spread is 6 points wide. So the spread widths also add up. So in this instance, the total net debit of $1.30 is the maximum risk. But here's the situation. FINRA, which is the regulating body of all brokerage firms, defines a butterfly as a 1x2x1 butterfly. So this is actually a solid question from a margin standpoint, in that if you follow FINRA to the letter of the law and what it says, that it's either a butterfly or it's not, and in order to get margin relief, it needs to be a 1x2x1 butterfly, which this obviously is not, right? It's a 2x3x1. It's a Christmas tree butterfly. So in that instance, some brokers will be forced to charge you one of the credit spreads inside of the butterfly, because it's not a standard butterfly. So what I'm seeing here, he said $740. I mean, I think it should be 600. 6 points wide should be $730, because the net debit is $1.30, and you got a 6 point wide credit spread. So I would think it would be $730 based off of the fact that FINRA the brokerage firm has decided to follow FINRA to the letter of the law, and they are not giving this the butterfly treatment, if you will, or doing risk-based margin. So the total risk to this, from what I can see here, is $1.30, and that is correct, and that's your maximum loss. But it looks like you're going to have to put up some more money based off of the rules of that specific brokerage firm.
The joys of FINRA and margin and account size, which actually brings us, since we're cranking here, let's just keep going to our next question, kind of related. This comes from Ron S6. He's got a very straightforward question, but an important one. He wants to know, what is your suggested minimum account size to start trading options? This is an interesting issue these days, Brian. We're seeing a lot of different people coming in, maybe new entrants to the space. A lot of talk about, newer entrants like millennials don't have the, traditional 5,000 to 20,000 to put down in an options account. Maybe they got 500, so there's all different approaches to this space and people trying new things. We saw that big push a few years ago with the mini options, trying to make what at the time were expensive options, and things like Apple and even things now like Amazon and Google make them a little bit more price friendly for newcomers to the space. But at the end of the day, it is still, somewhat capital intensive to trade options out there. Even if you go out there and sell your proverbial one lot on a put to get started on something, you have to tie up a lot of capital in case that stock goes against you, as our friend is learning here, even with something like a fly from debit spreads. The margin requirements sometimes can be a little bit onerous. So obviously, Brian, more is better, but people can't all put down $20, $50, $100,000 to start off their brokerage account. I know you guys have a lot of different account sizes over there in Ally Land. For someone who's coming in new, who's getting started, putting aside that more is better, what would you say is a realistic starting point that isn't onerous? 5,000, 10,000, up to 20?
Well, this is a little bit of a tough. I kind of like to see people trade some stocks before they get into the options. As a matter of fact, inside the options playbook, we suggest one of the better strategies is to start by doing a covered call, which assumes that you can buy 100 shares of that underlying stock. So we do have a couple of registered investment advisors in that are covered call sellers, cash secured put buyers, and they say you need to start with 25K, and that's mainly because you need to get going. And if you need to buy 100 shares, you have to have some capital to do that. And what they will then focus on are ETFs, or exchange traded funds, that track sectors and selling covered calls against them. Okay, so with all that being said, if you don't have that type of cash, if you don't have the 25K, the next best thing to do is to look at buying in the money leaps on stocks that you would like to trade. So if I were to start a portfolio, I would want at least 3 stocks to learn how options move, and I would want to be able to buy those 3 leaps. So let's go in and just say, worst case scenario, I don't want to just take my money and hope that I'm right on this one stock. I'm going to buy 3 stocks, and I'm going to go in and buy leaps on all of them, and they're going to be fairly expensive option contracts that I'm going to trade. And I might dollar cost average into these, buy them at different times, but you're going to need at least $5,000 to do that, and at least at a minimum. So let's just stick with I'd say just like a normal portfolio. If you're going to treat it that way and you're not going to use them for pure speculation, I'm going to buy one in the tech stocks, the FANGs, either Apple, or I'm going to look at Facebook or something where I can buy a fairly long-term option contract that is in the money, that acts a little bit as a stock surrogate. And then maybe I want to go into financials. So I look at Bank of America, I look at Citigroup, whatever underlying I want to choose, I choose one of them, I make my best pick, and I buy another in the money option contract. Then we go into healthcare, so I look into pharmaceuticals, I look at Johnson & Johnson. So I treat it just like I would a stock portfolio, where I picked a sector that I want to go into, and then and you can do that in options. Now, my thing that I see from these questions, and most of them is, and this scares me the most about a question like this, is a lot of people look at it as, I'm going to approach options because I heard I can get rich trading options and I can speculate on out-of-the-money option contracts. And why do I want to trade options? Because I can buy a lot of them because they're cheap. And I run away from that. That's why I sometimes like people to look at covered calls. I like looking at strategies in the options world where you reduce your risk. So it was a disjointed answer. Ideally, I would like you to start by doing covered call writing, but if you don't have the capital, you have to have at least $5,000 or $10,000. I want you to buy 2 or 3 solid companies, and you use options as a surrogate for buying the stock. So that's where I come in at.
Yeah, that's a good suggestion. Obviously, the covered call you mentioned before, that's got a stock component. That gets expensive, just putting away the capital for that. Meaty in-the-money call is going to be meaty as well, but you're not suffering as much from the time decay aspect, which always comes back to bite people when they're going long premium. This is we probably could spend hours just on this topic. What do you want to trade? What is your desired strategy? Okay, here's how much capital you reasonably should have for that. But I think your starting points there, Brian, are a pretty good one for someone just kind of coming in and dipping their toes in the old options water. Let's keep cranking here. Our boy Lance here, Brian, seems to be a fan of yours. He's got a lot of questions.
All right.
Let's see how many we can get to. Lance Everett says, "Hello again, Brian." I guess he's written it before. He says, "Still enjoying the Options Playbook radio program. It's my quick options education fix for the week. I listen on my commute to work every Thursday." Oh, good for you there, Lance. We love to hear from guys like you. He goes on to write, "I have a few questions for your next Huddle episode, if you don't mind." He's polite. I like it. If you can only answer one, then that's fine too. What a nice fellow. All right, let's see how many we can get to, Brian. He's got a bunch here. He says, he's got specific episode questions. I love it. He says, "You talked front spreads on episode 227. Do you ever use more traditional ratio spreads outside of repair scenarios, of course?" bonus. I like this. Bonus points if you know where the term front spread came from. I'll give you double bonus points for that last one, Brian. We'll start there because I've asked a million people who've been around the space forever where front and back spread came from. I've heard a million different answers. I've never heard one that's really satisfactory to me. So if you know that, I'd be curious as well. And then, 227, I believe that was your Costco. Was that the Costco episode?
I'm not 100% sure.
I'm going to pull it up right now and check for sure.
Okay.
It was, yes, your Costco back spread captured during earnings episode. So that's what he's referring to. And he wants to know if you do the more traditional ratio, which is typically what people do. Buy one, sell two, or buy one, sell six, whatever their ratio is. Obviously getting net short units, but they like to do it because obviously that gets to get them to a lower debit or perhaps even a credit if they're really, really greedy. So he wants to know, when do you use such a strategy outside of the given, which is the stock repair?
Okay. Yes, there's a lot in that, and I'll try to be quick so that we can answer a few more of Lance's questions. But in general, front spreads are going to leave you naked in option contract. And no, I don't know where front spread comes from, but maybe Samantha Bee's TV program Full Frontal. I'm not really sure, but you're flat out naked. I guess that's a good job. Good way to look at it. But you're going to be naked if you're going to just do a front spread. You are buying one and selling two. The ratio does not work together. The brokerage firm will require you to have the naked requirement. If it's not an IRA account, they might not even allow you to do it on the call side, period. So do I talk about it much? No, I really don't talk about naked options in general because I don't know who's listening out there. And it's really for the advanced investor to ever be naked in an option contract. But with that said, I like to use front spreads, and this isn't actually mentioned in the playbook, as a covered call on steroids. So the way that you look at it is a lot of people will sell covered. I have 100 shares of stock. I will sell a covered call, and I hope the stock gets up to that level and the stock gets called away. Well, you can do a ratio front spread and tie it to the stock, and then you're no longer naked. And if the stock goes up to that strike price that you've sold, you'll get more bang for your buck with a ratio front spread if you are correct on your forecast. And it's a very interesting alternative to the covered call. Now, as usual, if you do that type of trade and you are incorrect and the market goes down, you can't get it done for as much of a credit to the account. So just selling the call outright usually is going to bring in more credit. But if you do the ratio front spread as an alternative to your covered call position and you are correct on your forecast, you will do much better overall on the capital gain on the stock. So, no, I don't talk about it, and I did not cover it inside the options playbook, mainly because it's a naked option contract and it leaves you naked by doing it.
Yeah, naked short units. That's Samantha Bee or not. That's never a good thing. All right, he's got the ever-present question here for number 2, Brian. He wants to know, what are your thoughts on the crypto boom? No options yet, but they are coming. And is Ally planning to jump on the crypto train? So 3 questions in one. This guy's really jamming them in.
All right. Crypto train. In short, Ally, no, they decided against going down that road. And it's mainly because of the risk and the overall risk to the firm. You have to have a full team just to watch crypto as far as management is concerned. So we're not going down that route at this stage. I mean, things can change, but we kind of made that decision when it was really hot and the stock was rocking and roll, or I should say Bitcoin was rocking and rolling. So overall, it's just I have no idea what it's worth. I have no idea what you should be trading it for. And I personally haven't ever dipped my toe in that realm. And just overall, the policy of Ally Invest is we're just going to lay down until the urge goes away, basically.
You're not alone in that scenario. Here, this guy's full of compelling question. Usually we try to limit it to 1 or 2, but this guy's so on the ball. I'm going to keep rolling with him. He says, do you ever use short calendars? So selling longer term and buying nearer term, obviously kind of the inverse, the opposite of what a lot of people like to do, Brian, which is typically they buy the calendar, they buy the longer term, sell the nearer term. A lot of them think of it as a kind of inexpensive way to finance the longer term option. So that's why they do it. But this is the flip side. We don't see a lot of people talking about the flip side, the selling the calendars. Is that a go-to for you? And if so, when, sir?
once again, I think it's good that we had this question to go right along with the front spread, and that's because it leaves you short. It leaves you naked short an option contract. The brokerage firm does not give you margin relief if the short option contract has a longer expiration than the long option contract. So I usually don't talk about them at all inside when I'm talking to just the general public because of the naked option thing. And in general, though, I think it's an interesting trade. I think it's interesting to look at. You obviously manage your risk. If you get out before the first expiration, there's a lot less risk overall from doing the trade. So there is safety by doing that trade. And I don't mind it. But once again, you still have to have the approval from the brokerage firm to be naked option contracts, and there's going to be a large margin requirement. But the actual Greeks and the actual dynamics of that trade are interesting. If you think the stock is going to move more than expected overall, that's when you want to look at doing a long short calendar trade, is the way I should say it, even though you could still pay a debit for it.
Yeah, you're right. This guy's. I mean, that's another topic we probably could spend an hour on. The short count. We did touch on it recently on the advisor's option here, Lance. So if you want a more in-depth look at short calendars, head on over to the advisor's option. I think the episode is just titled "Short Calendars." You can find out more information about that. And all right, let's take it home with this one, Brian. He wants to know: is there a sequel to the Playbook in the works? Although the show is kind of like an ongoing live update / sequel, so that's probably better. Thanks again for making my Thursdays fun and informative. I like this guy. He's got good taste, Brian. And he's right. The show is kind of like an ongoing update sequel to the book. So I guess in that sense, you don't ever need to make a Playbook 2.
Well, right. And that's one of the things about the playbook, and it always comes with the disclaimer. We're just trying to learn about option strategies. Normally, overall, we don't look at 20 different strategies, but we're just trying to come up with underlyings that might be interesting based off of the market conditions when we talk about options playbook radio. So a lot of people would go on out and just kind of stick with 3 or 4 strategies and they try to make them work. And if that underlying doesn't fit into that strategy, look for a new underlying. So we're taking a totally different perspective when we talk about options playbook radio. So with that said, is there a sequel? No, not at this time. And part of the issue is I don't know how much bigger we can make the options playbook. What we can maybe add 4 or 5. We would throw front spreads in there, and short calendars would be a couple of trades that we don't talk about. But the bulk of the strategies have already been discussed, and the only way that we would do a sequel, if we were looking to do it, is it would be more about managing. The sequel would be all about managing, and that's a real tough book to write because there's not a perfect, you can't say, oh, here's 40 perfect scenarios that you should hedge your portfolio in. If you can come up with those 40 perfect scenarios, then we could write a book about it. But I say 40 because that's what the options playbook features, is 40 different strategies.
Yeah, I mean, the playbook itself breaks down strategies, right? Then what do you need? You need examples, a lot of timely examples, which is what this show is all about, right? Is a lot of timely examples of using those in the real world. So that would be hard to do in a print form. By the time you did, like, let's say the Costco ratio spread, it would be out of date. They could listen to it in a timely fashion, like Lance says, on his commute, which is a good time to be listening, Lance. And then they kind of use that in their own training. But this seems like, maybe I'm biased because I like podcasts, but this seems like the ideal medium for addressing that sort of need, which is kind of cool. Great. Speaking of addressing, you guys addressed us with great questions. A lot more we'll get to on a future Huddle episode, I promise you. But in the meantime, Brian, if people want to check out the aforementioned playbook, maybe they want to shoot you more questions so they could be like our friends Lance and Boos and Ron S6 and all the others here today and be featured on the show, where should they go? What should they do, sir?
Well, exactly. Well, they can do more of the same through all the mediums via Options Insider Radio, but they can also email me directly at theoptionsguy@invest.li.com, and that's the options with an S guy at invest.li.com. And I just want to say thanks for listening. And I always love it when we can huddle up and actually answer some of these listeners' questions. So until the next time, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook was brought to you by Trade King Group. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to TradeKing.com/ODD to review additional risks involved with trading options. Securities offered through TradeKing LLC, member FINRA and SIPC.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.